There's a couple different ways to use them. A lot of traders use them to try and trade in between, buy when it hits the lower band, sell when it hits the higher band. That's one way to use them. Another way
Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by Charles Schwab. I'm your co-host, Joel L. Connon, with Dan Nieman on the line. He is a portfolio manager of the Neiman Large Cap Value Fund. Dan, how you doing this morning?
Good, Joel. How are you doing?
Doing good. So we were just talked real briefly before we came on the line about all this volatility, and your voice kind of picked up there, and you must like this volatility.
Yeah, I do like the volatility. I mean, especially in our Neiman Large Cap Value Fund, we're bottom-up investors, so we're taking a fundamental approach to picking stocks and to building positions. And all the stocks in our fund pay a dividend. And besides paying a dividend, we also sell covered call options on each and every stock in the fund. And depending on what the market's doing, will be more or less covered on each particular issue. So, the more volatility there is, it was a hot button in the past couple of years, volatile markets. The more volatility there is, the better the option premium when you're selling a covered call, and the more protection you get on the downside when you're selling it.
Yeah, but let's just talk about, I mean, you got the dividend, and that is bringing in some yield. You're selling the covered calls, which is good because you're also bringing in some price, but what about it? I mean, are you out there buying puts on these things too? Because I mean, you are naked if those calls go, become worthless. Do you do that, or only at particular times?
We don't sell puts in the fund itself. We always hold the position in the stock. So we're, like you said, we're collecting that dividend. And if the stock doesn't go up, we're obviously keeping that stock and keeping the dividend. What we like to do is, and when I say we, my dad and I co-manage the fund. We've managed it together since 2003. We push, we'll say hold 10,000 shares of a particular stock, and we'll sell maybe 10 calls, for 1,000 shares out of the money, 5 to 10%, and we'll just sit and wait and hold that stock and hold those, outstanding short option contracts for the time period anywhere from, say 2 to 4 months, 5 months. And again, if the stock doesn't go up because the market doesn't treat our stock favorably, then we'll keep the stock and we'll keep the dividend and we'll continue to hold that position. So in a way, selling the call for us is a way to just enhance the yield, enhance the income like we talked about. And it also helps us set a sell discipline on the upside.
Well, what I alluded to is that I didn't mean selling puts. I said buying puts, because if you own a stock, you own the dividend, you sell the call, you're bringing the premium, you're protected to a certain level. But if the stock, eats through all that, so you don't. What I'm asking is if you don't hedge on the downside at all.
No, we're not doing any downside hedging. We're not trying to, again, buy the put and put ourselves into the stock at a lower price. What we'll do is we'll take the cash that we've generated from the dividends and the options, also cash from new investors, and we'll buy, average cost into stocks on the downside when we feel it's appropriate.
Okay, so are you all about fundamental analysis, or do you like to throw some technical analysis in there as well?
I think the only time we use any sort of technical analysis is on the upside when a stock's run its course. Really, we're looking at fundamentals. We're looking at simple metrics too. We're looking at price to book. We're looking at low debt. We're looking at low PE. We're looking at growth in revenues and earnings over a 3-year and a 5-year period. And when we talk about dividends, we're looking for dividend growth as well. Doesn't have to be high dividend growth, but some sort of dividend growth on a year in and year out basis.
Okay, now you talked about like taking a position in a stock, and we'll just throw out a theoretical, 10,000 shares. Let's say you want 10,000 shares of Procter and Gamble. Do you just throw your 10,000 share out there, bid, and say, "Come and get me"? Or do you try, which is a tough way to go nowadays, because
no, we've been managing the fund for over 10 years, so a lot of the stocks in our fund when we talk about buying a new stock, let's say, and we're looking to buy into something that's now hit our screens, we actually use Schwab for our individual. We manage an individual RIA as well, where we have about $200 million in assets. And so we use Schwab to clear a lot of our accounts, and I use Schwab screens. And inside of the Schwab screens I have set up, I basically am going to screen on a monthly basis for new potential stocks to put into our portfolio. And it takes a few months, maybe 3 to 6 months to actually initially buy a certain stock. But let's say it's something we've held for a long time. A Procter & Gamble is a good example of a stock we've held in our portfolio for quite some time. We've built a position already, and we've sold calls against Procter & Gamble, and maybe a few thousand shares have been called away. And then, of course, if the stock drops and we still see it in our screens or we see it as a potential buy, we'll add more to that position in the long term.
Okay, so you're constantly moving in and out of this. It's not like you're saying, "Oh, wait, we're buying 10,000 shares of Procter and Gamble and we're holding it until the cows come home." You're kind of playing the stock according, maybe using a little bit of technical analysis when it gets a little frothy on the upside to sell some calls, but you're basically just holding that position and trading around it according to your options positions.
Yeah, according to the options positions and what we need as far as cash, if people liquidate the fund or we get a slew of new cash, new investors come in, a new advisor starts using our fund in their portfolio, we maybe need to put that cash to work. We also use our cash position inside the fund to protect ourselves as well. So like right now we're more in the 10% range as far as cash goes. We could get all the way up to 20 or 25% if the market starts to pull back. In which case we'll sell some of our positions, or maybe not our entire position. We'll sell pieces of each position to eventually buy into a lower market down the road.
GGB says he's at 17% a year selling covered calls. I think I must be, I don't know if that's the return on his portfolio. I think that's pretty darn good. Are you guys at around that ratio, or where are you at on that?
Well, it's tough to compare ourselves with someone that's, say, just selling covered calls. I'm not quite sure what he does in his portfolio per se. Our fund itself is up in the 8% range. We're trying to obviously compare ourselves to the Dow. We only hold between 38 and 42 stocks inside of our fund. So when we compare ourselves to, say, the S&P 500 with 500 stocks, we're not always right there in line with the S&P in up markets. But selling covered calls, we're just really looking to enhance the dividend. So if I can get a, say, 2% average yield across my portfolio from dividends, and I can get another 1 to 2% from selling covered calls to enhance that yield, that's really all I'm looking for, is to return some more to the investor and, again, protect on the downside.
And how much do you manage?
The Neiman Large Cap Value Fund has about $35 million in assets. We have 2 other funds we manage. One's a balanced allocation fund, which would be my recommendation for the average investor, something that is it's a fund of funds. There's about $25 million in assets there. And then the Nieman Tactical Income Fund, which is our latest fund we launched 2 years ago, is a tactical rotation fund that rotates between high yield ETFs and high yield bond funds into cash. When the markets are going down, they'll rotate into cash. And total Neiman funds is about $80 million, and then we have about $200 million in our advisory firm that's for separate accounts.
And all right, so the big fear the big reason for caution with buying these high dividend stocks is if interest rates turn and they start to go up. And Janet Yellen did a nice 2-step at the last Fed meeting here. So that, what if interest rates start to creep higher? Is that going to make you reevaluate your strategy with high-paying dividend stocks?
Well, we've had this strategy going for 10 years plus now, and I think sure we could see a bit of a sell-off into out of high dividend yielding stocks. Again, we're looking for stocks that yield on an average of 2%. So we're not really looking for REITs. We're not looking for these huge, 8% yielding stocks. Some of our stocks, like an Altria, is up over 4.5%. But most of the stocks range between 2 and 3%. So I think, in a way, it'll just create buying opportunities for myself as really a long-term holding investor. If interest rates do climb, which they're not promising they're going to climb a huge amount over the next 1 to 2 years. They're just talking about maybe incrementally increasing interest rates. I think that, we'll get a sell-off and that'll create a buying opportunity. And as a value guy, I'm always looking at buying opportunities.
We have a question coming out of the chat room on a stock like GE. Is that something that meets your criteria for for your portfolio. It hasn't really recovered from the financial crisis like a lot of the other stocks, but pays a nice dividend and is just kind of steady. Is that something that you take a look at?
I would take a look at it if it hit our screen. Right now, GE has not hit our screen. I can pull it up real quick and probably tell you that the debt to equity on GE is quite high.
Okay.
It's
Good point.
almost 300 to 1 on and we're looking for stocks with less than 1 to 1, less than 100% debt to equity. So that would be the reason GE wouldn't hit our screens. Everything else in the stock looks good just from a quick snapshot. PE down below 20 right now. That's nice in the PE department. Dividends obviously over 3%. That's nice as well. But the debt to equity is what throws it off of our screen.
Yeah, I'm just looking at GE here, and it's sitting on some support here. Cold's luck if you're trading here. GE had a couple lows right here in this area, so you definitely want to see it holding right here. Just going back to that last question or earlier question I had about when you need to buy like 10,000 shares of Procter and Gamble, you do it
Right.
over a period of time. You go with the VWAP, or do you do something like that, or you just say, hey, we need to buy it between 82 and 82.50, and we're just gonna work the price. Is that how you do it, or do you have traders actually working the orders for you?
Well, I do most of the trading for the fund. We use a trade desk, but really, it's like I mentioned before. We're looking for stocks that are going to hit our screen multiple times, and as we see it hit our screens multiple times, we'll say, okay, we've got about 40 stocks in the fund. Right now, we have 42 stocks in the fund, and so we want to put a new position on and say take a position off, something that's run its course and has now really increased its, year to date it's up, on a 1 or 2 or 3 year basis it's up, and P is real high, yield has dropped considerably. So we're going to do a swap out probably, most likely, and say get out of one position, get into a new position, and put it in at the average sort of 2% of the fund as a holding. So maybe 8,000 shares, maybe 16,000 shares, just depends on the price of the stock and where we're sitting at with cash and where we're sitting at with percentage across the board in all of our stocks. So we may go with a 2% on a new stock. We're not ratchet up any higher than that, but get a nice position going because it's obviously hit our screens now for multiple months.
Okay, sticking with your discipline, buying high dividend stocks, using covered calls as a protection. Dan Nieman, portfolio manager of the Neiman Large Cap Value Fund. Dan, thanks for coming on the show today, and we hope to speak to you again soon.
All right. Thank you, guys.
Okay.
Appreciate it.